After a full month of volatility in July, the US stock market has moved beyond a simple upward trending phase and entered a more complex transition phase. The market is shifting from an AI tech-led expansion toward a combined environment of high interest rates, energy inflation, tech derating, and sector rotation. On the surface, the indices are still being supported by a handful of heavyweights, defensive sectors, or short-term outperforming sectors. But inside AI, semiconductors, and high valuation technology stocks, the pressure from a potential bubble unwind has already started to appear in advance. This does not mean risk has not emerged. Adjustments inside technology stocks tend to come before the broader market truly weakens. Going forward, as long as the credit market does not deteriorate significantly, cash flow assets such as energy, defensives, utilities, and insurance can still absorb part of the capital rotation. But if market conditions worsen later, this adjustment may escalate from tech derating into a broader deleveraging of risk assets. So when looking at the US stock market now, what truly matters is where capital is withdrawing from and where it is flowing into. Over the past 6 months, the US market has been almost entirely supported by a single AI theme: semiconductors, memory, servers, and cloud computing. Anything related to AI capital expenditure could command a valuation premium. But since June, the parts of the AI chain with the biggest previous gains, the most crowded positioning, and the fullest expectations have already shown clear signs of loosening. The market is no longer willing to pay excessively high prices for future growth unconditionally. Capital has not completely left the market. It has only begun searching for a new pricing anchor. The first category consists of assets that can absorb energy inflation and benefit from geopolitical risk. The second category consists of assets that still benefit from AI infrastructure build-out, but do not carry such extreme valuations. The third category consists of assets that do not rely on the AI narrative, but can still generate stable cash flow in a high interest rate environment. The three stocks we are looking at today, XOM, SO, and CB, correspond to these three lines. XOM is the short-term oil price play, trading on geopolitical risk and energy price elasticity. SO is the medium-term power play, capturing the real electricity demand behind AI data centers. CB is the long-term cash flow play, centered on underwriting profit, investment income, and book value compounding. They do not belong to the same industry, but the logic for being constructive on them is highly consistent. When AI technology stocks begin to derate, capital rotates out of growth assets built on stories and moves toward assets with cash flow, real demand, and pricing power. XOM, a short-term trade on oil prices and geopolitical risk premium. Let's start with XOM. On July 17th, XOM closed at $147.36, up about 0.97%. On the same day, the S&P 500 fell about 1%. The first driver for XOM is oil prices. Military actions between the United States and Iran escalated again, and Brent crude rose about 4.59% that day to around $88.10. As soon as the market starts to worry about transportation disruptions, oil prices immediately price in a risk premium. For XOM, the most direct impact of rising oil prices is improved profitability in its upstream business. Energy stocks become a destination for short-term capital seeking inflation protection and geopolitical risk hedging. The second driver is XOM's own earnings preview. Its second quarter profit may increase by about $5 billion compared with the first quarter. XOM's second quarter adjusted earnings are expected to reach around $15.7 billion, roughly 3 times the first quarter level. This means XOM's current strength comes from the combination of oil risk premium and short-term earnings improvement. At the same time, it happens to stand in the direction that benefits from the current market rotation. From a technical perspective, XOM's 52-week range is roughly between $105 and $176. The current price of $147 is in the upper middle part of that range. More importantly, the moving average structure is key. The MA5 is around $145.48. The MA10 is around $142.30, and the MA30 is around $142.22. The three moving averages are in a bullish alignment. The stock is trading above its short and medium-term moving averages, indicating that the short-term trend remains relatively strong. For XOM, the area around $145 is the first level to watch. This is not an isolated technical point, but the zone where capital is still willing to support XOM as long as the oil risk premium remains. If oil prices continue to be supported by geopolitical conflict, the support around $145 will carry relatively strong significance. A deeper observation zone is around $142, where the MA10 and MA30 converge. If the stock pulls back to this level and stabilizes, it would indicate that short-term capital has not abandoned the energy theme. But the logic for XOM must be kept within the right time frame. In the framework of this article, XOM is more suitable as a short-term trading vehicle. Its core drivers are geopolitical premium and expectations for profit improvement ahead of earnings. XOM will report earnings on July 31st. Before the earnings release, oil prices and geopolitical news will be the main drivers. After earnings, the market will reassess how much of these profits can be sustained. If the US-Iran conflict cools down, or if transportation risks around the Strait of Hormuz ease, the risk premium in oil prices will fall quickly, and XOM will also lose part of its short-term support. So XOM represents the current market's short-term capital demand. When technology stocks are releasing bubble pressure, capital needs a landing place that can hedge oil prices, inflation, and geopolitical risk. As the AI trade cools, power becomes the more tangible AI asset. Now let's look at Esso, Southern Company. On July 17th, Esso closed at $95.30, down about 0.8%. On the same day, the S&P 500 fell about 1%, indicating that the utilities sector still has a certain defensive character. But Esso's logic is not only traditional defense. What truly makes it worth watching is the growth in electricity demand driven by data centers. A cooling AI tech trade does not mean AI infrastructure demand immediately disappears. The market is no longer willing to assign high valuations to all AI stocks, but real investments in data centers, GPUs, HBM, servers, and power infrastructure are still driving the industrial chain. In the first quarter of 2026, Esso's data center electricity usage grew 42% year over year. The company disclosed that its total large load pipeline exceeded 75 gigawatts, with fully contracted power service agreements reaching 10 gigawatts. First quarter revenue was about $8.397 billion, up 8% year over year. Net income was about $1.356 billion. The company expects annual EPS growth of 7% to 9% from 2025 to 2028. These figures show that Esso's logic is not short-term sentiment, but medium-term load growth. As long as data center construction continues to move forward, electricity demand will continue to rise. Even if AI stocks themselves suffer valuation compression, power infrastructure may still become a more foundational and more stable beneficiary within the AI chain. However, Esso is not without risk. Its core pressure comes from capital expenditure and financing costs. Esso's medium-term logic depends on two variables: whether data center electricity demand can continue to grow, and whether regulators allow the company to recover capital expenditure through electricity rates. From a technical perspective, Esso's 52-week range is roughly between $75 and $99. At the current price of $95.30, it is already close to the upper end of that range. The MA5 is around $95.68. The MA10 is around $95.88, and the MA30 is around $94.84. The three moving averages are close to converging, showing that the stock is consolidating near highs and has not yet formed a clear breakout direction. For Esso, any technical breakout must rely on fundamental validation. What could truly allow Esso to break above the previous high of $99 is continued upside surprise in data center electricity usage in the July 30th earnings report, or stronger signals from management on capital returns and regulatory cost recovery. From a trading perspective, Esso is better suited for waiting for a pullback rather than chasing above $95. The area around $94 near the MA30 is the first level to watch. If the stock returns to the $92 to $94 range while data center load growth and regulatory recovery remain intact, the margin of safety at that level would improve noticeably. If the stock directly breaks above the previous high of $99, it would also need a clear catalyst. For example, the earnings report would need to confirm that data center electricity demand continues to exceed expectations, or the company would need to raise its future capital return guidance. Without fundamental support, breakouts in utility stocks are often difficult to sustain. SO represents the current market's medium-term capital demand. If capital is no longer willing to keep chasing semiconductors, it may spread toward electricity, power grids, and energy infrastructure. CB, no AI story, but durable cash flow in a high-rate era. Finally, let's look at CB, Chubb. On July 17th, CB closed at $352.16, up about 2.46%. On the same day, the S&P 500 fell about 1%, showing that CB clearly outperformed the broader market. CB's first quarter core operating profit was $2.689 billion, or $6.82 per share, up 85% year over year. Its property and casualty combined ratio was 84%, meaning that for every $100 of premium income, claims and expenses accounted for only $84, leaving the remaining portion as underwriting profit margin. CB's ability to maintain a relatively low combined ratio over the long term shows that its core capability is not chasing hot themes, but consistently pricing risk correctly. More importantly, investment income is another key factor. CB's first quarter adjusted net investment income reached $1.84 billion, up 10.1% year over year and marking a record high. In a high interest rate environment, insurers can earn higher returns on their float and investment portfolios, which is exactly the advantage insurance stocks have over technology stocks. From a technical perspective, CB's 52-week range is roughly between $264 and $365. The current price of $352.16 is only about 3.6% below its 52-week high of $365.29. The MA5 is around $346.85, the MA10 is around $350.08, and the MA30 is around $337.94. The three moving averages are in a clear bullish alignment, and the long-term uptrend remains intact. From a trading perspective, there are two ways to approach it. The first is to wait for a post-earnings pullback. If the July 21st earnings report meets expectations, but the stock pulls back because of profit taking after good news has been priced in, the $345 to $350 range near the MA5 and MA10 can serve as a base building observation zone. The second is to wait for a deeper systematic pullback. If the broader market continues to correct and CB falls to around $330 to $338 near the MA30, while the company's combined ratio and investment income do not deteriorate, the valuation margin of safety at that level would improve significantly. CB's long-term logic depends on its ability to continuously generate underwriting profit and investment income, driving long-term book value growth. CB is more like a long-term compounding machine. It does not need to tell an exciting new story. It only needs to keep pricing risk correctly, convert premiums into profit, and turn float into investment returns. 3 stocks, 3 time frames, putting XOM, SO, and CB together. They are not 3 randomly selected stocks. They are 3 capital answers after the current market shift. XOM corresponds to short-term risk premium. Holding XOM in the short term means watching oil prices and geopolitical news, not simply long-term energy demand. SO corresponds to medium-term infrastructure logic. Its key variables are data center electricity usage growth, capital expenditure pace, and regulatory recovery progress in the July 30th earnings report. CB corresponds to long-term cash flow compounding. The constructive view on CB is based on its risk pricing ability, not single-quarter market sentiment. In summary, the trajectory of the U.S. stock market going forward can be simplified into one sentence. In the short term, the indices may still be supported by heavyweights and defensive sectors, but upward momentum has already weakened. If technology and semiconductors cannot regain support from earnings and interest rates, The market will continue to rotate toward energy, insurance, utilities, power infrastructure, and cash flow assets. In this environment, investors should not focus on which of XOM, SO, and CB is the most popular. They should focus on which anchor their portfolio is missing. If the portfolio lacks short-term risk premium, look at XOM. If the portfolio lacks medium-term infrastructure logic, look at SO. If the portfolio lacks long-term cash flow compounding, look at CB. The market will not stop looking for opportunities. It will simply shift from buying stories to buying cash flow, real demand, and genuine pricing power. Cut through the noise and see the real picture. If you're vibing with this content, smash that like button and subscribe. See you in the next one.